an associate professor at the Lebanese University. I am the head of the finance department at the Lebanese University Faculty of Business, third branch, Tripoli. I'm so glad to be a host by the Open University of Cyprus. Today's session will be about international banking and finance. Hope that you take benefit from it and you enjoy it. Today's outlines are about the foreign exchange market. You get to know more about the spot, the forward, and the currency risk, the interest rate risk, and the credit risk that may occur while you are dealing with any foreign exchange market. You will get to know the importance of diversification and how to do such a diversification and how it affects the risk attached to any financial tool. Also, if we have time, we'll get to know more about some crises like the subprime crisis that occurred in United States of America in 2007, 2008. And we also get to know a bit more about the Lebanese crisis that is nowadays actually happening, and it is in the main of the foreign exchange market, and how the Lebanese are dealing with such a crisis. And if we have still time, we will talk about the Egypt crisis and how Egypt got herself out from crisis that has occurred when she was changing her interest, her rates from the floatant, from the fixed exchange rate to floatant according to market. So I will start with the foreign exchange rate. How to know the foreign? It's called the forex, and it allows the currency to be exchanged. So this is the market where you can take orders for exchanging currencies. And when we talk about the spot is you take action for today's actions. So the forward is for expanded delays. So you exchange rate for a future time. Although the spot is for today's actions, and lots of companies are faced to have currencies. And when a company has an international activity, she has to pay her transactions in the foreign countries' currencies. So she has to sell units to get herself the foreign currencies to pay her bills. So once we do this exchange, this is the foreign exchange market. And the foreign exchange, as brief, is where currencies are traded and where currencies are exchanged. So instruments that are used in the foreign exchange market are the SWIFT. And in 2002, we started the SWIFT Internet, and it's called the SWIFTnet. And this main mode of transaction is made between interbanks to do the transfer by telex or by SWIFT to do such an exchange for the currencies. So the payment transmission system is associated with currencies clearing methods, and we have two clearing methods that are the most deal with when it comes to currencies and clearing currencies methodology when it comes to exchange currencies. We have the CHIPS and the SHOPS. The CHIPS is the clearinghouse interbank payment system, and the SHOPS system is the clearinghouse associate payment system. The CHIPS for is you will get to know that the CHIPS is for the American system and the shops is for the British system. So when we talk about the correspondence between each bank or in each country, we have the Nostro and the Loro. The Nostro account is the account opened by banks with its foreign correspondent, and it records entries in foreign currencies. So if you open your account in dollars, so you will receive a dollar in it, so you are on Nostro. The Loro, you open your account and you only records entries in your national currencies. So if you open it in a system and you are receiving only Lebanese pound or euros, and even the transaction is done by dollar, so you are opened with a Loro account system. So when you are dealing with the SHIPS system, the clearinghouse interbank payment system, it provide the clearing for transaction involving dollars, US American dollars. So you will be dealing with the Bank of New York. So clearing transaction is done through accounts, and it held this bank at the New York Federal Reserve in United States of America. Once you are dealing with the shops, the Clearinghouse Association payment system, this platform system allow clearing system transaction while payments are in the pound, the English pound. So you will be dealing with England pound currencies, the English system. So when the transaction involves more than one clearing system, so when, for example, if you are dealing with euro and dollars, or you are dealing with pound and dollar, what type of transaction? The clearing is no longer simultaneous with the European and the American system. They do not do operation at the same time. So you have to per compensation system you have to establish. So first you go to you need to use the fixed net, the foreign exchange netting, which clear transactions between banks operating in London and send the balance of uncleared transaction to the official system, shops or EAF system to do the clearing between among the group itself. So the organization of the spot for foreign exchange market, you go, for example, if you go to the Paris foreign exchange market, every working day by telephone you can do you do the transaction. You can directly call the bank, and you can go through the brokers and you can do the transaction. The foreign exchange market is called over-the-counter market. This is to say that transactions are not officially standardized, and this is not a specific place such as a stock exchange where transactions are centralized and the quotation is well with good regulation. So when you are on over-the-counter system, you need to know that you are holding the risk on yourself. You will be dealing with the risk. You will be handling the management of the risk, or to do the risk management for the transaction you are doing. It is a one-on-one market with no regulation, no standard, no guarantees are done on the over-the-counter market. So be aware with such a specification. So who are the stakeholders? So when you are talking about a foreign exchange, you are talking about an over-the-counter market. Who are the stakeholders that deal on such market? We can classify the stakeholder in banks, the brokers, the central banks, and the clients, because each one of them have the rights, have the allocation to do the exchange and to do the operation. So how it works, yani how the foreign exchange market works when you are on the spot position. So you are on the spot, so you are doing the transaction today and you are doing the exchange today. So the main object of the spot forex is to enable the exchange of the currencies instantly. So it has to be instantly, or you are on the forward. In general, you need to know. So if it's lots of amount, if you are talking about big amounts, you will need 2 days, 2 workable days to do the trade. So it is most common today that currencies are delivered, especially when you are dealing with big amounts. Currencies may take 2 days, 2 workable days to deliver the currencies to the order of the spot exchange. So prices at which exchange take place between 2 currencies is the spot exchange rate, and we will see lots of examples about the spot exchange rate, or the spot exchange rate of one currency expressed in unit of the other currencies. So we will be like referring to lots of examples when it comes to such currencies. So we will be like how to expose $1 to euros, for example, or $1 to Lebanese pounds. And you will see the difference between dealing with currencies like euros or dealing with currencies like the Lebanese pound, because it differs from the location, and it differs from the typology of the type of used exchange rate. Is it the fixed one or the floated one? And what is the difference among those two currencies type, or those two currencies exchange rate type? So when you go to the international market as quotation, as rating, all currencies are quoted against the dollar. So because we know that dollar is the international most common international traded. So all currencies are valued in according to dollar. So when the quotation is for euro, so 1 euro is $0.8 for per $1. So $1 can be traded on the exchange, on the foreign exchange market, for 0.8 euro. And how to see 1 euro, how it's given in dollars. So it is the you invert the situation. If you want to see 1 euro is worth 1.25 US American, you have to do the inverse. The inverse is 1 over the 0.8. So if you do the calculation, 1 over 0.8, you will have 1 euro over 0.8 US American. You will know the value of 1 euro against 1 US American. That's an easy way to do the presentation. So the presentation of the foreign exchange codes used in the work of the quotations organization, you can go to use organization like Reuters and lots of several financial newspapers that do the official exhibition of the official rates. And Reuters is one of the most credible for having on-spot foreign exchange codes and rating. So it figures between a figure to the right of USD and the left is euro. It indicates the value of $1 in euro units. And if you see it, if on the right part the euro faces USD, it's the value of 1 euro in dollar units, in US American dollar units. So for example, if you see the quotation as USD/euro 0.8, it indicates that $1 is exchanged for 0.8 euro. And if you see it euro against USD 1.25, it indicates that €1 is exchanged for 1.25 US American dollar. So the figure given in euro/USD is the inverse of that given for the USD/euro. AKA, if you want to know the euro/USD, all what you have to do is 1 divided by the USD euro value that you have in your exchange quotation rate exposed on Reuters news or any financial news, credible financial news, so that you can know the actual rate. So this is an easy way to do the direct exchange from international market. So on international market, the currencies began all quotes against the dollar. The number of quotation is so limited, but you need to know that the exchange market is, even though it is out of counter market, but it's so important in transactions and in quantities of transaction done on such market. The disadvantage of such of systematic quotation against the dollar is that the forced situation which to exchange currencies other than the dollar, in which other to calculate a cross rate. So if you are on for example Swissra, and you want to do the Swiss franc to pound to the English pound, what to do, how to manage such calculation. And we know that the official market, between parentheses official, it is the dollar against all other currencies. What to do, how to manage to calculate a cross rate. It's easy, don't panic, it's an easy path to manage. So for example, if you know from the quotation of the euro and the Swiss franc given against the dollar, so if we see such quotation, so the quotation of the Swiss franc against the euro can be مثلا deducted. يعني you can deduct the euro quotation for each Swiss franc from the quotation of dollar. So if I gave you US dollar / euro 0.68, for example, those are examples, and I gave you the USD for the Swiss franc, all we have to do is to do the cross rate exchange, and you will have the currencies of one euro against franc Swiss franc. So all what I have to do is to do the cross. It's using the cross path, 1.10 divided by 0.68, and you will have the cross rate currencies. We will get to know to see if it is cross rated to know on a forward market expense what to do. So for example, the euro is quoted, another example, I like to give lots of examples. So if the euro is quoted at 1.3481 for USD, and conversely the price of USD is equal to 0.7418 per euro, what is the inverse, yani how to have the 0.74 euro? It's easy. You do 1 divided by 1.3481, and you will have how much it equals €1 against the US American dollar. So quotation on national market have both situation. We call it certain and uncertain, or also known as direct and indirect quotations. So as general rules, quotations are said to be indirect once you establish in units of local currencies necessary to buy a unit of foreign currencies. So for example, if you are in Switzerland, the dollar is quoted as follow: one US American against the franc Swiss franc is 1.0041, aka that means that the number of the Swiss franc per dollar this quotation is said to be indirect quotation in Switzerland. So we need to know in which country we are and how to expose this currencies. We will be like, we will know that if you are in situation of direct or indirect establishment, also known as certain or uncertain establishment of quotation. So if you are in Switzerland and the quotation is mentioned as USD against the franc, the Swiss franc, so you are on indirect quotation. So on the other hand, if you are in France, for example, the dollar is quoted as follow: euro versus against the US American, and it's like 1.3481. That means the number of dollar per euro, so the rating is said to be direct quote in France. So if you are measuring the quotation from your national currency toward the foreign currencies, you are on the direct quote. If you are measuring the foreign currencies toward your national currencies, you are on the indirect quotation market. So you need to know that. You need to be fully aware of that. So once you are on, you know the location, you know the current exchange or the national currency, you will get to know if you are dealing with direct or indirect quotation market. So in the Eurozone, when we talk in the Eurozone, quotation are established in units of foreign currencies needed to buy 1 unit of the national currency. And the quotation in the Eurozone are displayed in number of currencies unit for 1 euro, which shows the desire to consider the euro as an international currencies. So in countries that expose euros against dollars, they want to do that. They want to expose this national currencies between two parentheses as an international currencies of dealing with international exchange. So once we know that in which market we are and in which with which exposure of currencies we are, we get to face 4 types of new keywords. They are appreciation, revaluation, depreciation, and devaluation. So how to manage to know if we are in case scenario of an appreciation or depreciation of our national or international currencies, or in revaluation or devaluation of the national currencies. So depending on the management of the quotation, so if you know the quotation, so you know if you are on direct or indirect quotations. So once you know the quotation management, you will be knowing if you are in appreciation modality or devaluation modality according to the situation of quotation. So depending on the management of the quotation, any increase or in the prices of a currency means an appreciation or depreciation of the currencies. So it depends on the demand and the offers of this currency. So you need to know the examples so that it is more clear. So if you are in France, if the dollar is quoted $1.3280 US American dollars for 1 euro, so let's say we are on November 8, 2010, and it's like 1.3481 US dollar per 1 euro. This quotes it's for November 17. So after a few days, the quotes of $1 against 1 euro has moved from 132.80 to 134.81. What the value of the euro has increased, so it has appreciated. So because we are talking about in France, so they are dealing with a floating exchange rate, and they are dealing with this situation. So we can see that the euro has increased in numbers, so it has appreciated over the dollars. So once the euro is appreciated, on the other hand, we can say that the dollar has depreciated against the euros. It's so clear. If the first currencies, we are in France, so it's the national currencies has appreciated, directly we can know that the foreign currencies related to dollar has been depreciated against the euro. So we can see the spread. Yani we can know how we can know the depreciation rate, and the depreciation rate is so easy. We got the difference between the currency rate of the forward. So it is we know that it's on November 17th. We minuses from the rate of the November 8th, and we divide it on the rate of November 8th. So, and sure, we multiply it by 100 to see it as percentage. So we know that the rate of appreciation of euros is equal of 1.5135% according to the depreciation of the dollar in the France market, in the France in France area, to be sure, to be specific. So in summary, how to generalize in quotation. In the case of a certainty quotation, as in the Eurozone, if the price of a currency, which means the foreign currencies, for example, the dollar, increase, this means that this foreign currencies is depreciating, and the one of on the other hand, the national currencies is appreciates. And in the case of quotation under the uncertainty quotation, as in Switzerland, when the price increase, this means that this situation means that the foreign currencies, for example, the dollars, has appreciate, and that on the other hand means that the national currencies has depreciation against the foreign currencies. This is a general rules as in summary, just to be clear. So we have to do a distinction between appreciation and devaluation, and between appreciation and revaluation, and it's the way in which the price of currencies is established. So if you are in a system of fixed parities, so the currency rate are established by government authorities. So when you say and you are in system of fixed parities, it's like Lebanon, and currency rate are established by government authorities. It's like the central banks. They do interfere actions to control the mass of national and foreign currencies, so they maintain the same exchange rate level. So when the value of the currencies rises, it's called revaluation, and when it falls, it's called devaluation. Nowadays, we can say that the Lebanese pound is in case of devaluation against the foreign exchange like euros. So on the other hand, if you are in system with a floating exchange rates, currencies prices are results from confrontation of supplies and demands. So you are confronting the market. The market is the one who is fixing the currency prices, and in such cases we can talk. For example, France is using the system of floating exchange rate. So currencies are fixed according to the orders of the market. And in case of an increase in the value of currencies, so the term used is appreciation, and in the event of decline, the term used is depreciation of the currencies. So once we know the system of the system used to establish the currencies, we will get to know the difference between if we are going to use a depreciation or devaluation, or appreciation or revaluation of these currencies. So knowing the place is crucial and it's so important to deal with so that we can use specific keywords to describe the situation. So nowadays we can use the bid and ask prices. The bid price is the price at which the forex trade agrees to buy currencies, and now we are preparing ourselves to move toward the forward market. The forward market for the exchange rates. So we use like lots of keywords like the bid and the ask. The bid prices is the price at which the forex trade agrees to buy currencies, specific currencies. So investors go to the bank and wants to know they want to buy currencies. So if Maria wants to go to the bank and she wants to buy dollars, she is on the bid price situation. Although if she wants to trade to sell euros, she is on the selling price to see how much she will get to exchange those euros she wants to sell. So the selling price, or also known as the ask or offer, it's for the price at which the trader agrees to sell a currency. You will see that in general we go to banks, and banks give us the display screen against dollars and euros, for example. So we get to know the spread. The spread is calculated also by percentage. So you have the ask price minus the bid price divided by the ask price. It's the same as used in previous slides. Now we are now preparing ourselves toward the forward market. So the quotation of the euro against the dollar is displayed, for example, on a Reuters screen, are as follows. Euros against dollars is 134.93-135.03. This currencies is for the bid prices, and 134.93 is the bid price. So obviously the lower than the ask price is the bid price, and on the other hand, the 135.04, it's the ask price. The spread between the bid price and the ask price is calculated in percentage. So for example, if we are using the quotation of euro against dollars as giving on Reuters, the difference is equal in percentage as 0.0814%. It is the spread between the bid price and the ask price for this international currencies shown on a Reuters screen for a specific date. As a general rules, how to maintain a general rule, this difference is much smaller than that associated with banknotes, and it's not due to the same reasons. The spread is the trader's remuneration and depends on the risk taken by the traders. So you need to know that traders has to gain some remuneration for the action of selling or buying from new currencies. It depends if it's local or in foreign currencies. So this spread is the remuneration, and it depends on the risk associated with the two currencies in use. So if you are using like two currencies like dollars and euros, those are considered as safe two currencies. When those are safe, so you can see that spread is 0.0814 percentage. Although if you are talking about currencies like the Lebanese pound and the US American currencies, so you will see that the spread is bigger because currencies trade are holding risk bigger than the risk attached to euros and dollars. So when the currencies traders announce the price to a client or to the currency trade announce it to another banks, he doesn't know whether the latter wish to buy or to sell the currencies. So you can go to any guichet and to ask the quotations. So trader give you the bid and the sell prices at the same time, because he doesn't know if you are going to buy or you are going to sell. He has to give you a specific answer, so he gave you both of them. So the spread depends on the currency being traded and its volatility to the market and its volatility to the risk attached to the market where the quotation is done. Quotation are announced by indicating the 4 digits. So after the decimal point, you need to show always 4 digits. In general, I will show you after a few slides how they do abbreviation of such display. So, for example, I like to do to give examples directly. The quote of the euro against the dollar will be displayed as follows: 1.3493 is the bid, and 1.3403 is the ask price. And you can see the 4 digit after the decimal point. The second digit after the decimal point is called the figures out, and the fourth, the basis point, are called the pip. And we can equal it in 0.01% or also known by 0.0001 to see the figures after the decimal. So, for example, if you go to Reuters and you see the quotation on the screen, the euro against dollars quotation is as follow: euro against dollars is 134.93 and 135.05, which is what is the currencies of US American versus against the euro. So don't panic, it's easy. You reverse the previous one. So you reverse it, you put 1 divided by 135.04 for it will become the bid on your left side, and the ask it on your right side, so it will be 1 divided by 134.93. So if you are going to see the quotation or the rating of one US American dollars against 1 euro, it's 0.7405 for the bid and 0.7411 for the ask price. As a quick calculation for the exchange rate. It's so easy. So what to do if it's a cross quotation? If it's a cross, so it's like you are trying to display the currencies between the pound, the English pound, and the Swiss franc. How to do it? How to manage such a cross quotation? So you go to the bank A and you ask the quotation, and the bank A display the following quotation. It gives you euro against pound, English pound, as follow, and it gives you euro against the Swiss franc as follow. So what is the quotation between the English pound and the Swiss franc quotation? So first of all, you need to know you need to be specific. So you need to know it is we calculated to know first the bid price for English pound and Swiss franc, and then we do the calculation to have the ask price for the English pound and the Swiss franc. So the English pound versus against the Swiss franc, the bid price is the price at which the bank wants to buy the pounds with the franc. So it is the number of a franc it wants to be paid for 1 single pound. This is equivalent for bank A to buy euros with Swiss franc, then to sell these euros to obtain the pounds. So you know that it is a continuous exchange. So the bank A gives 1.3526 franc and gets €1, into which he will resell it and gets the 0.8518 pound English pound. So the bank A therefore has to have 1.3426 Swiss franc, and he will get the 0.8518 English pound, and that's way the English pound against the franc Swiss in her bid prices is 1.5761 per each one single pound against Swiss franc. So for the ask price, so it is the number of the Swiss franc that Bank A wants to sell 1 pound, 1 English pound. This is equivalent for the Bank A to sell the pounds against euro and at the bid price, of course, and to sell those euros against the Swiss franc, also known in which that way he will obtain €1. He will sell the 0.8506 pound, and it obtain €1, to which then they will sell it for the Swiss franc at her ask price. As a result, the bank gets 1.3439 francs Swiss franc with 0.8506 English pound. That's how they get the ask price for one pound against 1 Swiss franc for 1.5799 per each. Therefore, we can obtain the following quotation for each single pound against the Swiss franc as cross calculation from quotations showing. You need to know that there is a situation of arbitration opportunities once you are calculating the cross rates. It is possible that you will have arbitration opportunities because because you may be dealing with those cross quotations, and you will be on different market. So opportunities of arbitration may occur. So this calculation of cross rate makes it possible to know whether implicitly or explicitly the exchange rate are the same everywhere, including commissions. Otherwise, we are talking about risk-free profit opportunities would be possible. It is in the principle of the absence of arbitrary opportunities which is generally respected because enough professionalism in the world follows quotation constantly. So they do observe market, they do follow, they do take care of each single transactions. Otherwise, there will be lots of arbitration opportunities if you are dealing with huge amounts, or you are dealing with different banks located in different European zone or different geographical zone. For example, if the bank A is located in the Eurozone, and it's displaying the following quotations between euros and English pound, we can check the bank B, which is located in Zurich, and giving the following quotation. So we have done the calculation for bank A, and if you are crossing rates between bank A and bank B, you will see the difference. So after doing the cross calculation of bank A, we have noticed that the bid price and the ask price for English pound and franc Swiss are as mentioned, and we know now the bid price and the ask price for the showing prices from bank B located in Zurich. So as you can see, there is a difference. between Bank A and Bank B. So here we need to know that there is an opportunity of arbitrage. So you can buy English pound from Bank A, which will sell you those pounds for 1.5755 Swiss franc, and then you can resell them to the Bank A, which will buy them for the 1.5761 Swiss franc, and you will earn 0.006 per each book of trade you have done, per each single pound you have exchanged. This is an arbitrage opportunity, but if you consider it without any extra fees or any extra commissions, and it will show on big amounts, because showing 0.006 on single pounds will not make so much difference. But imagine those difference or arbitrage opportunities on like 1 million pound. It will make difference from only buying only from doing this transaction. So between two different geographical zone and two different banks, you can do big amounts of arbitrage. So the course of an operations, how to do such a cross rate. So if you are a French company who wants to sell $1 million, so I give you an example of a French company located in France, and this company wants to sell $1 million. So you need to know that this company, she called several banks to ask them about their quotations, without telling them whether she wants to buy or to sell. She is like on a scoot, and she is asking for quotations. She didn't mention if she is buying or selling, so she didn't specify her situation. Although she is on a scoot because she wants to sell $1 million that she have. Take into account that it is a French company, so it is located on France, and we need to know that on France it's a company where we are on direct quotations, and France use the floating price, the floating exchange rate parties. So these quotations she received from Bank A. It is for euros against dollars. It is 1.3500, 1.3512. Although they may be using this abbreviation, so if it's the same for the both two figures after the decimal, they may use only the difference at the end as mentioned, as following. So this quotes mean that the company A agrees to buy euros, the bank A agrees to buy euros for 1.35 per dollar, or to sell euros for 1.3512 US American. More specific, it will give you the following quotation as mentioned. So with using the abbreviation, with people follows in the market, and they will immediately understand that first two decimals are the same as showing. So we see that this company asked lots of banks for quotations, like from Bank A, B, and C, and she received those quotations, 1.350012. So this is the bid, and this is the ask quotation. On the Bank B, the same, and the Bank C have gave her also quotations for €1 against the dollar exchange. So she got the three different quotations from three different banks. What she wants to do. So the company is now under the process of selling $1 million. So the company must choose the bank that give her the most euros in returns for $1 million. So in our example, Bank A will give her 0.74 million euros for $1 million that she is offering for sale. So how she do the exchange, how she do the agreement. Talaxes are then exchanged to confirm the oral agreement. So she calls, she received the quotations, banks give her the quotations, and she tell Bank A that she wants to sell $1 million for the upon the quotation offered by them, and then they will send the telex to confirm the oral agreement. Transaction actually take place 1 day later for the exchange between the US or the Canadian dollars or any kind of and you need to know that it may needs 2 workable days for any other exchange in transactions, especially for big amounts. They need 2 workable days to prepare those amounts in cash. So we have two orders may be given by customers at the best or at a limited prices. At the best, made at the first quote price for which the exchange can actually take place, and at limited prices, the client sells at a minimum price or buys at a maximum price. So the clients at the limited price tells the dealer, the trader, that this is an interval where in which he fixed the minimum price or a maximum price to do the selling or to do the buying or to take situation. Not to forget, you need to add commissions to each transactions, especially on the sized one, because traders need to make profits from such transactions, so they add commissions on transactions like this. In any events, a customer will pay a larger spread than that given by the bank, or even though that interbanks may show such quotations, you can go to see the counter prices that may show a less amounts of spread or ask or bid quotations. In addition, the interbank bid and ask spread and commissions are smaller for larger currencies than for small currencies, because they already deal with such currencies. So when it comes to foreign exchange rates risk, you need to know when we have exchange risk and why, and how to manage such risk when it occurs. So it's the risk is due to preoccupationary principles. It's due to fluctuation or volatility in exchange rates, and we must go on provisions for any exchange risk that may occur in any situation. So going to exposure for foreign exchange risk affects any company and any investor benefiting from revenues or having to make payments in foreign currencies and or processing with assets or debits in foreign currencies. So when you are dealing with importation, exportation, you are the most to confront any exchange risk that may occur. When economic agent received or settle flows in foreign currencies, it is exposed to the consequences of exchange rates movements and on its receipts or payments or on assets or on debits. Therefore, it is necessary to choose the appropriate instrument to cover such risks and to do the management. We have lots of derivatives that may help to prevent or to be covered from the risk that may show on foreign exchange market. So when we talk about currencies, when we talk about holders, when we talk about investments, we talk about two situations. Either you are an importer or you are an exporter. So if you are an exporter, so you are dealing with exportations. So the foreign currencies received, so you are the foreign currency receipt holder. You are taking a long position on the dollar, for example. You are favored by an appreciation of the foreign currencies. So if you are an importer, so you are a debitor acquired all interested. So you make refunds. So you pay your supplies in dollars, for example. So if you are an exporter, you are dealing with exportation. So the domestic currency is equivalent on its net income or net assets increases when the appreciation of the foreign currencies occur. So increase in the prices of competing product in your local currencies. So this increases the equivalent of revenues of overseas sales. So you will become more competitive in your local currencies. So if you are dealing with import as importer, so you are dealing with importation, so you are on short positions for dollars, you will be penalized by any appreciation of the foreign currencies. The value of its settlements in local currencies is increased for your situation. So it even its debits, it's increase for you. So if you are an exporter, so although you are dealing with exportation, so any increased gains achieved affect your currency's prices remain unchanged. So you are now on situation of competitiveness linked to a more aggressive pricing policies for your situation. So the foreign exporter is penalized by appreciation of their currencies. So the value of their sales at unchanged volumes and prices decreases. So more competitiveness is eroded. Market share defense policies are the most common to be used in such situation. So I will give you a quick examples to be like in so clear positions. So a euro-based investor holding bonds in dollars. So you know the difference between bonds and share equities. So this is an investor who is holding bonds in dollars, and he is a euro-based investor. So this investor will benefit from the appreciation of these currencies. On the other hand, he will be disadvantaged by the opposite reason in the event of a depreciation of the dollars, because he will be touched by the investments done on those bonds who bought in dollars. So the existence of a non-exchange positions on a currencies at a given moment, claiming dollars equals debits in dollars, does not mean the absence of a potential exchange position. The maturity of receivable differs from that of the debits, so it is relative for the exchange positions, and as opposite to an absolute exchange position for this investor who is based on euro positions, geographical positions area. So the foreign exchange positions really determine the risk incurred by the company or by the investor, and it's on the position that the company runs a risk of loss following an unfavorable variation of exchange rates. So the company's foreign exchange position is an inventory of all foreign currencies accounting transactions. If we take the example of an importer, we will take that Moroccan companies called XYZ buy sunflower seeds from the American company DAF to make oil, to make sunflower oil. So you need to know that Moroccan companies is geographically in the north of Africa. They deal with the dirhams, Moroccan dirhams, and they are under the fixed exchange rate policies parties, and they will be importing seeds, sunflower seeds from American companies. So the price agreed with the American company is $1,000 per ton of seeds. The payments is scheduled 60 days, end of the month, the day after the delivery day of the seeds. So the price at the time of the acceptance of the offer by the company, the Moroccan company, is $1 equals 11 Maghreb dirhams. So this company may face two situations. The Moroccan company may face two situations once the payment period has been incurred after 60 days of receiving the seeds. So if the Moroccan company are in situation of importer, so she is doing importation of sunflower seeds from the American company. In case of revaluation of the dollar against the dirham, which means that $1 equals 11.5 Maghreb dirham, this company will finally have to pay per ton like 11,500 Maghrebian dollars, which means that she is under a loss in this revaluation of dollars against the dirham. In case she is on the devaluation of the dollars against the dirham, which means that $1 equals 10.5 Maghrebian dirham, the company, the importer XYZ, he will gain on this position because he will pay against the $1,000 10,500 Maghrebian dirham. Hope this example is clear. If you have any questions, feel free to raise your hand, and I will re-explain it if anything is not clear. So what happened? What actually happened with among those two companies, the Moroccan one and the American one? When the company imports semi-finished products or raw materials like the seeds, denominated by the foreign currencies, which is she is importing those seeds from US American country, so it must manage its exchange risk between the invoices date and the payment date. You know that she has to pay the bill after 60 days from receiving the seeds, so she has to accrue risk among those 60 days. If the imported products are used in the production of finished product instead of, for example, for export, poor management of the exchange risk causes an increase in the cost prices and therefore a loss of competitiveness, as shown in the second row. So in case of exportations, so if XYZ is in case of exportation, so let's imagine that XYZ exported the sunflower oils to the USA. So she prepares the oils, and she is now, this Moroccan company is exporting those sunflower oil to the US. She signs a contract of $5,000 with the company ABD. This contract is payable 30 days from the end of the month of the date of the shipment of the goods. So after 30 days, she will receive the contract. The exchange rate set in the offer and accepted by the American company is €1 equals $1, and $1 is 11 Maghrebian dirham. The months following the delivery of the goods, the Moroccan company could see entering its cash, and it shows like if she shows like those two situations. So the Moroccan company is in position of exporter in exportation of the sunflower oil. If she receives the sum of 57,500 Maghrebian dirham, it's a gain, because in that situation we can see that the dollar is revaluation of the dollars against the dirham. But in case of devaluation of the dollars against the dirham, and at that time when the $1 equals 10.5 Maghribian dirham, in that case she will receive 52,500 Maghribian dirham, which will cost her a loss for this case of devaluation of the dollars against the dirham, in case she is an exporter of the sunflowers oil to the US-American partnership. So you need to know, nota bene, to put concerning the foreign exchange positions, you must meet 3 criteria as a result. You have to be reliable. All modifications are integrated into it. You have to be clear, easy to read, and easy to update. And you have to update it, and it must be on a daily calculation to be like as clear as you can, as reliable as you can, as updated as you can. So you have to meet those 3 criteria. So as general rules, if the local currencies appreciate, it's likely that exports will decline as they will be less competitive. If affirm manufactures mainly for export, and appreciation of the local currencies will have a negative impact on the sales of the company. If the local currencies depreciate, so local sales should increase as the product produced become more competitive. Prices in foreign currencies, all other things began equals and decrease. Thank you for your time. Do you have any questions?
We thank you, Dr. Sarah Makhoul, for this
Thank
talk.
you, Dr. Mikhail.
If there are any questions, please ask them now in English, so you'll have an answer from Dr. Makhoul. Ερωτήσεις, questions?
Okay.
There is one in
Thank
writing.
you for your presentations. The best option is for diversified portfolios. Yes, Andreas. Actually, nowadays the best option to secure your investments is to go into diversified portfolio. Diversified portfolio can help you to reduce the risk attached to any financial instrument you are using. So if you do a small calculation, you can secure your investments with diversified portfolio, even for currencies, even for any financial instrument you are using.
Any other questions?
Also, Andreas, you can go to instrument that may help you to cover any risk that may attend. You can go for options like the call options or the put options, depending on your situation. If you are buying or you are selling any kind of things. So those options may secure your investments for a future delay of time. Go investigate about the options pull and call. Any other questions? Thank you, Andreas, for attending today's meeting.
If you have any other questions, please.
Please write it in English so that I can read it.
Okay, thank you very much. It seems that there are no questions. Once again, we would like to thank you Dr. Sarah Makhoul for giving us this talk today. And